What's going on, guys? This is Lucas from the Early Retirement Club here. And in this video, we are going to show you one critical method that Warren Buffett uses to pick his winning stocks. And we will use the Apple stock as an example to showcase how we use this method on it, and bought it as a key holding in our retirement portfolio. So let's get right into it. When we buy the stocks of a business, what we are buying really is its profitability. So as a result, the most important aspect to evaluate a stock is its profitability. I am sure that you know a range of metrics already, like gross profit margin, net profit margin, et al. But these metrics are of limited use. It is hard to compare them across different business sectors or industries. But today, we will show you the most important metric for profitability evaluation. The return on capital employed. ROCE. Sometimes, it is also known as ROIC, return on invested capital. Regardless of its name, the concept itself is the most important metric for measuring business profitability. And it is the key metric that Mr. Buffett uses himself. As the Grandmaster said himself, the best business to own is one that over an extended period can employ large amounts of incremental capital at very high rates of return. Next we will see why ROCE is so important, and showcase its importance by analyzing the Apple stock with it. ROCE is critically important because it measures the return of capital actually employed in a business. And it, therefore, provides fundamental insights into profitability. The key word here is actually. The importance is better illustrated by explaining the differences between ROCE and the more commonly quoted return on equity, ROE. By definition, ROCE equals the profit earned by a business divided by the capital actually employed to earn it. So if a business has a ROCE of 20%, it means for every $1 of capital the business actually employs, the business earns 20 cents. Not that bad of a profitability. Similarly, by definition, ROE equals the profit earned by a business divided by the shareholder equity on the book, actually employed to earn it. So again similarly, if a business has a ROE of 20%, it means for every $1 of shareholder equity that sits on book, the business earns 20 cents. So ROCE would simply be the same as ROE if the book value equals the capital actually employed. But more often than not, the book value and the capital actually employed are two very different things. And as a result, ROE is quite useless or even misleading for profit evaluation. And we will use Apple as an example to illustrate the above next. For readings new to these concepts, here we provide a tutorial to illustrate them. First, let's see how we analyze the ROE of a business using the Apple stock as an example. We first go to the income statement to find the net income. Then we go to the balance sheet to find the total share equity. And finally we divide the net income by the share equity to get the ROE. As seen, the ROE of Apple in the recent years has been in the range of 56% to 135%, with an average of 85%. Quite impressive. To put things into perspective, the ROE of the overall economy is only about 17%. So Apple earns 5 times more profit for every dollar of equity on its book than the average. Quite impressive. But wait a second. Share equity does not reflect the actual capital employed by Apple. For one thing, the business has a large amount of cash on its book. Whether holding a large amount of cash is good or bad is a different topic for another day. But as a business accumulates more and more cash, the book value increases and therefore ROE decreases. But this doesn't mean the business is becoming any less profitable at all. It could just still be the same profitable business that has more and more cash on hand. And in any case, the idle cash sitting on the book is not actually involved in the business operation. And in this case, the use of ROE is misleading because the inclusion of such idle cash distorts the picture of profitability. So what are the capital actually employed for a business like Apple? To estimate the ROCE of businesses like Apple, I consider the following items capital actually employed: working capital, including payables, receivables, inventory. These are the capitals required for the daily operation of their businesses. 2. Gross property, plant, and equipment. These are the capitals required to actually conduct business and manufacture their products. 3. Research and development expenses. Such expenditures are an essential expense for a technology business like Apple. Based on the above considerations of capital actually employed by Apple, here is a tutorial to analyze it step by step. First, we look up the operation cash flow from the cash flow statement. Operation cash flow is a more accurate measure of earnings than the net income from the income statement. Second, we work out the working capital requirements. Again, these include payables, receivables, inventory. And all these items can be looked up from the balance sheet. Third, we look up the gross property, plant, and equipment. And all these items can also be found in the balance sheet. Fourth, we look up the research and development expenses. These are usually found in the income statements, or the footnote of the income statement. After we get all the above inputs, we can now sum them up to obtain the total capital actually employed by Apple to make money. And finally, by dividing the operation income with the total capital employed, we get the ROCE on the last row. As seen, Apple was able to maintain a remarkable high level of ROCE over the recent past decade. It has been in a range between 121% and 179% with an average of 144%. The next slide will put things under perspective by comparing it with the row we analyzed earlier. Now this chart shows Apple's true earning power based on the analysis we just did. Again, as seen graphically this time, Apple was able to maintain a remarkable high level of ROCE over the recent past decade. On average of 144%. If you still remember the row analysis we performed earlier, its average row has been about 85%. So now you can see how much the row analysis distorts the profitability picture. In this case, it substantially underestimates the profitability of Apple. There are other cases where the use of row would dramatically overestimate the profitability of the business. And we will analyze some of those examples in our future videos. Finally, let's put the discussion under a broader context and discuss how we use Apple stock ourselves. As mentioned in our earlier video, we use two portfolios to manage our retirement funds. One conservative to take care of short-term needs, and the other one more aggressive, with a focus on growth in the long term. The more long-term portfolio includes more individual stocks we picked for their long-term return potential, and even applies a leverage to the stock holdings. Apple is a core holding of our long-term portfolio, helping us with the long-term growth need. And we are very glad of the performance of our long-term growth portfolio, as you can see from this chart. And picking winning stocks like Apple is key to drive such performance. As you see, our aggressive portfolio outperformed the S&P 500 index most of the time. It really took off and began to dominate the S&P 500 index shortly after the 2008 Great Crash was over. In terms of dollar amounts, the aggressive portfolio outperformed the overall market almost by more than 200% in the past 15 years. For $10,000 invested in the overall market, it has grown to $30,000, not that bad. However, our aggressive portfolio has growth more than six-fold, to almost $65,000. Truly impressive. This portfolio is our real portfolio, and we adjusted it monthly. We will update it and discuss more details in our future videos. With that, hope you've enjoyed the video and we will wrap up here. To summarize and recap, ROCE measures the return of capital actually employed in a business. It stands for the return on capital employed. And it is also known as ROIC, return on invested capital. It is the most important metric for profitability evaluation. In the case of Apple, the use of other metrics such as ROCE distorts its profitability. And ROCE reveal its true remarkable earning power. Thanks for watching and see you next time.